Okay, again, welcome to our Maryland Homebuyer Workshop. Again, my name is Jason Maida, and I'm with American Pacific Mortgage. We're super excited to host our first workshop with the Maryland alumni, and this is just a partnership we've been working towards over the last several months, and really excited that we have the opportunity to be able to share this workshop with you guys this evening. Now, before we start tonight's class, I got to say congratulations, go Terps. Big 2-point victory today in the first round of the NC2A tournament. So obviously that's a huge win, and now it's on to the field of 32 now. So super excited. So that's really cool stuff. So hats off to all of you for taking time, first of all, to, take a break from the tournament if that's what you're into, and listening to more about what mortgage and home buying looks like. So my name again is Jason, and what we do is we teach classes like this all across the country through our different alumni partnerships. Maryland happens to be one of our newest partnerships, and just couldn't be more thrilled to be able to partner with Maryland and the Alumni Association on being able to bring this material to you. We specialize in first-time home buyers. So we help educate first-time home buyers on what the process could look like for home buying. And we do things in very more of a consultative fashion when we meet with our clients. So we're designing financing options for them. So we are a direct lender. We're based out of California, but we are a nationwide lender, so which is pretty cool. And we offer a wide variety of products, including first-time home buyer assistance programs. So tonight's class is going to be about an hour. Like I said earlier, it's an interactive session. So as I go through tonight's content, we really encourage you to ask questions of us. We'll answer most of those questions on air, and then we'll carve out a little bit of time at the end of tonight's class for any kind of follow-up questions you might have. So here's talking points for tonight. We're going to talk a little bit about the housing market. I do want to spend some time talking about interest rates. As many of you have probably seen, the financial markets are kind of a little bit of a volatile situation, we'll say. We're going to start off tonight's class looking at a buy versus rent analysis. So we'll start that in just a bit. Take a look at credit. We'll talk about student loans and how those can potentially impact your qualifying. We'll look at various loan programs that are available to you as a first-time buyer, maybe even a second or third-time buyer. Documentation usually needed to qualify for your financing. Talk just briefly about some down payment assistance programs, and then we'll wrap up tonight's workshop looking at the process of buying and some of the next steps that might be for you if you want to kind of take that journey towards kind of figuring out what homeownership could look like for you. So when we think about homeownership, it's probably going to be one of the largest investments we make in our financial futures. And, for all of you that are taking time out tonight on a busy Thursday night to kind of learn a little bit more about what homeownership could be for you, that's hats off to you guys for that. And, when we look at the benefits of buying a house, there's a few things that happen. We create stability with our housing budget, because we don't have to worry about like a landlord that's increasing our rents every year when we decide to renew our lease. There's growth of wealth that happens through the appreciation of your home. This is an asset, so you have the ability to be able to have that asset kind of work for you and increase in value. And there's still some tax benefits that come along with owning a home. So you can still potentially deduct interest when it comes to your mortgage. Now, the first place we kind of want to start with in tonight's class is doing a budget analysis. And we're going to do that by doing kind of a rent versus buy calculator and taking a look at a scenario of what it could be of, continuing to go down this path of renting versus what it could look like with buying a house. So what do I have on my screen share right now is just a calculator. And by the way, in case you missed it earlier, all the material that we have from tonight's class is going to be sent to you via email tomorrow morning. And we also have this as a recorded version. So if you want to check it out on our YouTube channel, or maybe share that with friends, family, maybe some colleagues, they can also check out some of this material as well. Okay. By the way, in case I didn't mention earlier, so we work in our license in the DMV area too. So some of these programs, I know many of you may not be tuning in to us just from Maryland. You may be in other parts of the country. So we are a nationwide lender, so we can service your home buying needs in those local communities. Okay. So the analysis we're going to do with a rent versus buying, I know it's not going to be relevant for all of us depending on what our cost of living looks like. So, but we're just going to create a kind of a general scenario here. So this calculator from Freddie Mac is going to start with just the inputs of what our monthly rent looks like. So we're going to say $17.50 a month in rent. We're going to assume monthly renter's insurance of about $15 a month. And then we also add in an expected rent increase of 3%. Okay. So that's the first kind of set of data that we're going to put in. Now we're going to add in what the purchase price could be. And I know this is going to vary for many of us depending on what part of the country we're in, but we're going to put in a sales price of $500,000. Now, as you're going to learn a little bit later in tonight's discussion about loan programs, the minimum down payment is 3% for this level of purchase price when we think about a conventional loan, which is a Fannie Mae and Freddie Mac loan. You have your property taxes. Those will vary based upon the location of our home. Homeowners insurance, which is going to protect the home against any type of perils. You have maintenance on your house, which we have it calculated at $700 a year. Of course, that could be a little bit higher if we decided to buy an older type home. And then around loan information, we have a 30-year fixed mortgage input. We put our interest rate at 6.3. We're going to talk about interest rates in just a few minutes. Origination charges. When we think about origination charges, those are the costs that a lender is going to have as part of the overall closing cost for your home purchase. So generally, origination charges include like a processing fee, underwriting, maybe the appraisal fee. One of the great things about our partnership with Maryland, beyond our service and support for our clients, is that you get a discount in closing costs as part of our alumni partnership. So you actually get a $750 discount through our program. So that's really cool. Discount points is noted as 0 here, but let me kind of explain to you what discount points are. That's when you as a buyer decide to pay additional costs to help bring down your interest rate for your home purchase. So let's say the interest rate today is at 6.375%, but I want to pay an additional 1 point to bring down my interest rate. 1 point equals 1% of my loan amount. So if I finance $400,000, then that cost would be $400,000, that cost would be $4,000. Usually 1 point will bring down your interest rate about 0.25%. Okay. The other settlement services are going to be like title, escrow, attorney fees, some of the government recording fees that you might have for your county. We're going to put those as $6,000. But I'd say, as you're budgeting what your savings should be for your home purchase, we obviously want to consider our down payment amount, whatever that might be. But then we have closing costs. And I always recommend closing costs that you should estimate like 2 to 3% of your purchase price for closing costs, somewhere around there. Now, the other assumptions we want to make is appreciation of the home. So how much is my home going to go up in value? How long I'm going to be in the house, which we put 10 years. The cost of selling the house, which usually we estimate around 10%. That could be slightly less than that. Now, when you have a realtor that represents you, generally those realtor commissions are going to be paid for by the seller. So that's something to keep in mind as a future first-time home buyer. We also plug in our state and federal tax rate as well as a savings rate. Obviously, that savings rate goes up quite a bit, especially in this inflationary market. But that being said, when we look at the kind of the buy versus rent calculation, well, let's first of all look at the budget, right? So we know our monthly payment's going to go up quite a bit because the rent payment's $1,765, but the house payment's $4,100 a month. So we know that's a big jump. But at the same time, in fact, I was just talking to some first-time home buyers about this very same example, that when we think about renting versus buying, that's not going to necessarily be a fair comparison, right? Because when we think about buying, we got to also take it in all the opportunities that exist. The opportunity for appreciation of my home, the tax benefits that come along with owning a home, potential passive income. Maybe I decide to rent that property down the road. All those things need to be factored into our total cost analysis. Now, when we look at the cost of buying versus renting, and we say, okay, if I continue to do what I'm doing with renting versus buying, and that home appreciates, over 4%, my opportunity of buying versus renting is about $76,000. Now, of course, if you buy a lower priced home, you're not going to have as much upside in appreciation, or maybe you're paying more rent. Those numbers might not look as favorable. But when we look at the opportunity to buy, we really got to kind of look at the big picture, right? So let's answer a quick question that came in, and that is there a maximum in discount points that we can pay for upfront? Usually the maximum is 3%. Because there's what we call as a high cost amount. So as a consumer, we don't want your loan to meet that high cost or exceed that high cost threshold, because then it won't be financeable. So we want to protect the consumer to make sure you're not paying too high of an amount for your financing. So usually it's 3%. So 3% would equate to maybe a 0.75% or 0.75% reduction in interest rate. Okay. So that's what it looks like when we start off kind of on this journey. So we kind of do the buy versus rent calculation. Now let's kind of switch gears a little bit. I want to talk a little bit about the housing market. Now I know this is going to be specific to Maryland, but when we look at the housing market in general, it's really pretty similar across the country. We've seen a little bit of low inventory levels, and kind of what's driving that is, sellers not maybe super excited to put their homes on the market given what we've seen in past interest rate environment. And we're going to talk about interest rates in just a second. You can see here on this slide that homes are sitting on the market a little bit longer. So we're 42 months days on market. So we're seeing things sit longer. Buyer demand is not as high. Some of that is seasonality in the market. Some of this data that we're looking at right now is early 2023 data. We're going into the spring and summer buying months. Interest rates are starting to come down off of that, 7.25 high that we saw in November of 2022. So things are definitely starting to improve in the market. If we kind of do a look back further in this slide, you see prices, when we got into 2022, started to, they're kind of leveling, but then we started to see home prices shoot up a little bit in 2022. But then, we hit this kind of a wall in interest rates, which started to bring home prices down a little bit. Sellers had to cut prices because those homes were staying on the market a lot longer. Maybe buyer demand wasn't as strong. But I do think as we go into second quarter, which will start in April, we're really going to see an uptick in buyer demand. I think the latest numbers we saw was probably a 30 to 40% increase in buyer demand. So second quarter is going to be a much busier, quarter for buying. And then of course, as we move into the summer months, we'll see that kind of pick up. So I think the question is, where do interest rates go? And because that's going to kind of dictate what the housing market does. And this week has not been without some excitement in the financial markets. For those of you that are kind of watching what's going on in the financial markets, just a couple hours away from us, Silicon Valley Bank, unfortunately, became insolvent, and the FDIC had to step in with heavy pressure on, kind of what some of the bond investments they had, as well as we saw an issue with Signature Bank going through the same thing, really kind of put a spin into the markets. We've seen some economic reports coming out as of late. The manufacturing report today just came in lower than expected. So there's some real concerns in the market. Did the Federal Reserve kind of overcook interest rates? Did interest rates, get raised too quick? There is a Federal Reserve meeting coming up in the next few weeks. And what does that look like? There was talk before the unraveling of the banks happened this week. Would they increase rates 0.5%? Now the talk is, I think it's 75% chance it's only going to be a 0.25% rate hike. And in some cases, we're thinking maybe there could be a potential pause. But there's some caution around that because they don't want to necessarily pause and then create some fear in the markets of what recently has happened with the banks and maybe some uncertainty with the banking sector. So there's a lot of unknowns right now. I will say, though, unfortunately, bad news is generally good news for interest rates. So one of the things I'd encourage you to check out is the 10-year Treasury. As that comes down, I think that's floating around 3.43 right now. You're starting to see the 30-year fixed mortgage start to drop. Interest rates have really risen pretty quickly, especially with what's going on with inflation. And that's really why the Federal Reserve has been raising rates to combat inflation. This gray line represents the start of the pandemic. And as you can see, and many of you know that, as we went through the pandemic, interest rates hit a bottom of 2.5%, lowest rates we've seen. But as we kind of moved on the other side of the pandemic and really kind of right around Q2 of this last year, we saw rates start to climb pretty dramatically, which is represented here. And they ultimately kind of topped out around that 7.25 range. And now we've seen interest rates start to fall down a little bit now. Just last week, we had some concerns before we had the bank problems. Rates actually touched on 7%. Now they've kind of come back down. But I think as we move forward, we'll hopefully get those interest rates into a little bit more of a stable or hopefully lower rate environment. Now, interest rates are not all the same for all buyers, and it does depend on, your credit eligibility. Usually, if you have a 740 credit score or better, you're going to be able to obtain the best available rates in the marketplace. Loan product will play a role in that. The loan amount that you finance, what your down payment is. So if I put 3% down versus 20%, that could change my interest rate offering. We've talked a little bit about points tonight and the buy down opportunity. So that's a way that I can obtain a lower interest rate. And then the term of my loan can change what my interest rate looks like. If I have a 30-year fixed mortgage versus a 15-year fixed, usually the shorter my term of my loan, the lower my interest rate is going to be. It's our role in your kind of mortgage advisor to help design a financing option that works best for you. So when we sit down for a consultation with you and design a home buying plan, we want to make sure we put you in the best possible position from an interest rate perspective. Okay, so we'll take kind of all our knowledge that we know of kind of what's going on in the market, given your financial profile, your financial goals with home ownership, we want to design that right product for you. Now, credit plays a big role in your product offering, but as well as interest rates. And so as we teach these classes throughout the week, we really want to kind of help guide our home buyers on helping improve their credit, or at least knowing where they're at. Now, what's really cool about all the monitoring services that are available, like Credit Karma, Experian, Equifax, TransUnion, all of those agencies have their own monitoring tools, is most buyers, when they come to work with us, they have a really good idea of kind of where their credit stands. But there is a difference between what is shown on those monitoring tools versus what us as mortgage lenders use in evaluating credit eligibility. So I want to take you through the FICO score model for mortgage. And so it's kind of shown on here on this graphic. 15% of the FICO score is how long I've had credit. So the more mature some of my accounts are, the better my credit score could potentially be. 20% is going to be how much credit I have in use, or like new accounts that I'm opening. More importantly, that's going to be hard inquiries that are hitting my credit report. So that's 20% of the credit score weighting. 30% is going to be how much credit I have active for my revolving credit. So the more credit I have in use, the lower my credit score is going to be. So if I have a $10,000 credit limit and I have $7,000 in credit balances, that means I'm at 70% utilization. And that's going to really impact my credit score. So if I'm at that position with my credit balances, I really want to work hard to get that at least below 50%. And then once I've obtained that, my goal is now to get to 10% utilization. The last component to the weighting is going to be payment history. That's 35%. That carries the biggest weight. And when you have maybe late payments or past challenges, they're rated as 30-day lates, 60-day lates, and then 90+ delinquency dates. So obviously the bigger or the more severe the late payment, the bigger impact it's going to have on your credit score. Usually what I see is in the last 12 to 24 months from the date of the event of a delinquency is when we're going to see that impact to the credit score. So if I just had a late on my Capital One credit card in October, it's probably going to hurt my credit score pretty big time, as opposed to, let's say, that credit late was 3 years ago, right? Because it's kind of seasoned out a bit. Now, let me give you a kind of a tip for kind of managing credit utilization, because as I work with clients throughout the day, there's usually two things that kind of get in the way on the credit side of things. It could be like past challenges that we got to work on, but more so it's going to be on utilization. So you heard me talk about trying to get that utilization as low as possible. Well, here's that tip that I want to share with you. So when you get some time tonight or tomorrow, take a look at your credit card statements. So they have a billing cycle date. They also have a due date, right? So many of you are probably in the habit of paying on your due dates, maybe the full balance or the minimum payment, maybe a larger balance or a larger payment, I should say. If you can try and pay off or pay down that balance before the end of your billing cycle date, what's going to happen is that lower balance is now going to report out to the credit agencies. So when the credit agencies get the data in from the credit card issuers or the creditor, they're going to post that balance at the end of your billing cycle date. So by paying that down before the credit statement is issued, now you're going to have a lower balance and hopefully improve your utilization and have a better credit score. Okay, so that's one way to help kind of manage the utilization. Things we also want to consider is, looking at account closures. So, I talked to a client earlier this week. They were considering closing out a couple credit cards, but you want to be careful with that, because when you close out credit cards, you also can impact this length of credit component to the credit weighting. So, I know there's great benefits that come with opening up new cards and balance transfers and all that stuff, but you want to be careful with that, because that could hurt your credit score if you close out an old established account and then move to maybe a newer account, just because it has like all the great benefits. On the mortgage lending side, as you can see here, that every product has a minimum credit score. Now, as lenders, we look at all three agencies. So we look at Equifax, Experian, and TransUnion. We take the middle score of those three agencies. So if I'm applying individually and I have a 760 score, 740, and 720, we utilize the 740 credit score for qualifying. Now, if I'm going to apply with my partner, my partner has a 720, 700, and a 680 score, we have to take the lowest middle score between both borrowers. So in this case, we would use my partner score at 700 for the qualifying. So that's something we want to keep in mind, because if our partner has a lower credit score, it could impact our interest rate, could impact the mortgage insurance, and potentially could impact the product that we're eligible for. And then I want to kind of take you through, like, if you've had past credit challenges, how long those are going to remain on your credit report. Now, there's a credit update that's going to be in effect, I think either this month or next, where if you've had some medical collections, for example, they're no longer going to appear on your credit report. So that'll really help a lot of our clients that maybe have had insurance carriers that haven't paid on a debt or something. But if you've had some other challenges with your credit, this is how long they'll stay on your report. Now, the impact to your score is probably going to be in the most recent 12 to 24 months from the event date. So if I had the late payment, it's 12 to 24 months from that date. But this is how long they'll stay on the report. Okay. Student loans are one of the things that we take into consideration as we look at obligations for qualifying clients. And I know for those of you that do have federal student loans, I know they're under forbearance right now because still under the CARES Act, and there is pending forgiveness with the legislation that's getting ready, hopefully, to pass, right? Now, at the same time, we still have to take those minimum balances, and those have to be factored into the qualifying. So whether I have a $50,000 balance or a $5,000 balance, we have to take a minimum payment towards the qualifying of the mortgage. Now, if you entered into an income-based repayment prior to the pandemic, that's the amount that we can use for your qualifying today, assuming you haven't accrued any new student loan debt. Now, if you graduated during the pandemic and you haven't yet started repayment because they're in forbearance, we have to either A, set up an income-based repayment amount, or in that case, we would have to use the minimum qualifying payment. So usually for an FHA loan, it's 0.5% of your balance. For a conventional loan, it's 1% of the balance towards the qualifying. Sometimes with income-based repayment amounts, we can have a zero payment, and that is actually allowed for conventional loans. So that can certainly be utilized for the qualifying. Now, if you're back in school, you're probably in deferment. Even though you're back in school, we still have to count a minimum payment for the obligation, because we can't just assume that those debts are going to go away. So we have to make sure we factor those into a qualifying calculator called the debt to income ratio. We're going to talk about that a little later in tonight's class. Okay, now we got one question that came across already. Any questions from the class that I can help answer before we go into loan programs? Okay. All right. Well, again, we're trying to make this an interactive workshop for you. So if you do have some questions, feel free to use the chat function, and I'll do my best to answer those online. Okay. All right. Let's talk about loan programs. And these are kind of 5 of the core programs that are offered in kind of just traditional financing. So we have conventional loans, FHA loans, our VA loans for our veterans that have served and have eligibility under the VA product, USDA loans, and then jumbo loans. Let's talk really quickly about USDA loans and jumbo loans, and I'll kind of spend more time looking at conventional and FHA loans. USDA loans are going to be zero down payment options. Those are going to be for our clients looking to purchase in more rural, lesser populated areas. There's 2 factors that are really important with USDA. They do have the geographical restrictions, but they also have income restrictions by household size. So they can be a fantastic option for you. It usually has a minimum credit score of 620, but it does have that, location specific. And then jumbo loans are going to be for our clients that are looking to purchase beyond a loan amount of $726,200. Not always, something that's going to happen for our first-time buyers, because it does require at least 10 to 15% down payment. But with jumbo loans, they also have a reserve requirement. And what reserves are, it's the amount of assets that I have left behind after I've contributed my down payment and my 2 to 3% closing costs. A reserve, for example, would look like this. So if I had a minimum payment of, say, $5,000 for my mortgage, and it has a 12-month reserve requirement, that means I have to have $60,000 left behind in my checking and savings account, maybe my brokerage account or my 401k, after I've contributed the down payment and closing costs. So that may be a stretch for some of our first-time buyers, but nonetheless, it can be an option for first-time buyers. Now, conventional and FHA loans are going to probably be the space where 95% of our first-time buyers are going to elect, as well as, of course, the VA product too. Now, when we look at the conventional loans and FHA loans, the minimum down payment is 3% for a conventional loan up to a loan amount of $726,200. And for those of you that may not be in the DMV area, maybe you're in some other parts of the country, Illinois, New York, maybe California, and if there are higher cost of living areas, Fannie Mae and Freddie Mac will adjust the loan amounts based on cost of living. So let's say you're joining us from San Francisco. The maximum loan amount is $1,089,000 in the San Francisco Bay Area, for example. Okay. Now, these loan amounts get updated every October, November, and indirect lenders like American Pacific Mortgage put those in place as soon as we get word from Fannie Mae, but they're updated every year based upon cost of living adjustments. Now, conventional loans, when you put less than 20% down, carry with it private mortgage insurance. And we're going to do a kind of a side-by-side comparison on private mortgage insurance as opposed to FHA in just a minute. Now, let's look at FHA. As you learned earlier, it has a minimum credit score of 580 all the way up, and the loan amounts go all the way up to $726,200. That has a minimum down payment of 3.5%. And when we think about FHA, it's going to have a little more leniency when it comes to guidelines versus the conventional loan. Not only is the credit score requirement a little bit less, but the kind of the way in which guidelines are interpreted are a little bit easier for the buyer. Let's say I have a past challenge with credit, and maybe I had a 30-day late on my Capital One card 6 months ago. Conventional might be a little bit more concerned about that, where FHA, it wouldn't be as big of a deal. Now, PMI looks a little bit different between conventional and FHA loans. And let me talk about conventional loans, then we'll kind of look at FHA. So conventional loans have PMI, or private mortgage insurance, when I put less than 20% down. And there's a few different payment options for private mortgage insurance. There's monthly MI, there's split MI, and the monthly MI is going to be paid as part of your monthly payment. The split MI takes in consideration a monthly amount, but then you also pay a little bit upfront. So that's why it's called split. There's single premium, which is where you basically buy out the entire cost of the mortgage insurance upfront. It's pretty costly, not really the best solution for buyers. And then there's lender paid mortgage insurance, where you elevate the interest rate selection to help use that revenue to buy out the mortgage insurance. The most common option is monthly MI. And the reason why that is because MI generally has a cancellation option. So once I have 2 years in my home and 22% equity, I can apply to have that mortgage insurance canceled. Now, PMI is going to be based upon my credit score, what my down payment amount is, and how much I finance. So the higher I can get my credit score, even beyond that 740 level, if I'm at 800 credit score and I'm maximizing my down payment, maybe it's 15% or 10% down, I'm really going to lessen the cost of mortgage insurance. When I look at searches on Redfin or Zillow, what I find is those payments that are calculated out in those sites are much higher than what it'll generally be for PMI when you do a calculation through us. The reason why is those sites aren't calibrated with some of these features here in PMI or characteristics. So we'd encourage you to use our mobile app. It's a great tool. You're going to get a link for it a little bit later on. You can do your own calculations because you can get more of a truer number. And of course, when we do a consultation with our clients to design their home buying plan, they're going to get obviously an accurate number. Now, let's look at a conventional PMI example down at the bottom of the screen. So if I bought a house with a financing of $450,000 and my credit score was 740, and then I put only a 3% down payment, my PMI is $183 a month. Okay, so not as a big of a amount as probably what you'll see in some of your searches on Zillow or Redfin. Now, when we look at FHA looks a little bit different because FHA has two components to mortgage insurance. It has upfront mortgage insurance, which is going to be 1.75% of the loan amount. And then there's monthly mortgage insurance, and that's 0.55% of the loan amount. Now, you may have heard a couple of weeks ago, the federal government, FHFA, announced the reduction of mortgage insurance. It used to be 0.85%. Now it's 0.55%. And that really makes homeownership a lot more affordable for some of our FHA clients. Now, with FHA mortgage insurance, it can only be canceled through a refinance. So if you decide to refinance and then go into a conventional loan, that would, of course, create a whole new loan program and not have the mortgage insurance, assuming you had 20% equity in your home. Let's look at the same example for FHA PMI. So we take the same loan amount. Now, the difference is we do have to add the upfront PMI on top of my loan amount of $450. And then once I do that, coupled with the factor of 0.55, we have a monthly MI of 199.03. Now, whether I have a 620 score or I have an 820 score, this monthly PMI for FHA is going to look exactly the same. May change a little bit if I put 10% down, but for all in all, that's going to look the same for every credit score customer. Okay, so you may step back for a second and say, well, gosh, FHA just seems a lot more expensive of an option. And as I mentioned earlier, the guidelines look quite a bit different from FHA versus conventional. We may have a client with a challenge of a past bankruptcy or late payments or maybe a possible foreclosure. All those things, FHA will have a lesser seasoning period for financing versus the conventional loan product. Next stop we want to make in kind of this home buying journey in tonight's class is we want to kind of look at income qualifying and kind of some of the documentation around that. So for our W-2 wage earners, usually we'll need the last 2 years of W-2s, the last 30 days of pay stubs. Some type of verification of employment will occur throughout the process. Usually it's a verbal verification as well as a written verification. One of the things we hear in consulting with clients across the country is around my time that I need to be on my job. So a lot of clients think they have to be on their job 2 years in order to meet the qualifying for a mortgage. So the rule is actually 2 years between employment and education. So if I just graduated from Maryland in this fall, 4-year undergrad degree in accounting, but then I went out to Deloitte and got my first job in accounting, that education will help support me achieving that 2-year requirement. Same thing holds true if I decide to switch jobs. If I decide to switch jobs, I can show that I have 2-year work history or my educational support. We can qualify you knowing that you have an executed offer letter for that next house or that next job to purchase that house. For self-employed individuals, we're going to need at least the last 2 years of tax returns. You will have to be in business for at least 2 years to qualify under the mortgage. We usually see a profit and loss statement, balance sheet, and then we have to verify the business, whether through business license or maybe a CPA letter. Now, again, it has to be at least 2 years self-employed generally for qualifying. And then what the calculation looks like is we usually do a 2-year average of the net earnings for the business. One of the other things we hear are just questions that come up in working with clients is, if I have dual employment, so I see this a lot in the healthcare industry where we have a client that works 30 hours at one clinic, 20 hours at another. Like, how do we use both sources of income? So as long as we've been doing both positions for 2 years simultaneously, we can use both sources for the qualifying. Okay. Now, if I have side employment, let's say maybe I'm working as an Uber driver or Lyft driver, and I want to include both my full-time earnings as well as my my Uber driving, we just need to show that we've been doing both jobs for 2 years in order to use both sources of income. All right. One of the questions that comes up in working with clients is if I have, let's say my partner has a source of income, they're in the household, but they're not going to be on the application. Can I use their income for qualifying? And so unfortunately, any income to be used into the, kind of the formula for eligibility that person's going to have to be on the loan. Sometimes you can have what we call a non-occupying cosigner where they're not going to live in the house, but we're using their income and assets for qualifying. That's kind of different. But ultimately, to include income of a partner, they have to be on the application. In some cases, if you're looking at using rental income for your qualifying, let's say you're historically rented a room out and you want to use future rental income for your next property for qualifying, you can potentially do that under certain programs allowed under Freddie Mac and Fannie Mae. So sticking with income, let's talk about qualifying income as it relates to, and I think I mentioned it earlier this evening, which is the debt to income ratio. And debt to income ratio takes a look at your pre-tax income versus your monthly obligations. And so some of those obligations include credit card debt, personal loans, student loans, as well as the upcoming mortgage payment, which includes principal and interest, taxes, insurance. And I'll show you the formula in just a second. Usually we don't want those obligations to exceed more than 43 to 45% of your pre-tax income. Okay. Now, in some cases, that debt to income ratio can go up as high as 49%. But when we design home buying plans for our clients, we want to make sure that we're doing a couple really important things. We want to create affordability for our next home purchase. We want to make sure it's also sustainable, right? So we don't want to stretch out a client's budget to, beyond their comfort level. So we're not setting them up for success. So when we design home buying options for our clients, we're going to meet one-on-one, make sure we talk through budgets and see what's comfortable for them as a future home buyer. Here's the debt to income ratio calculation. So we're going to take a look at the principal and interest, the taxes, the insurance, as well as PMI. And we're also going to look at the HOAs. So if you're purchasing a condo, maybe an HOA, that's also going to get factored in. And so if we said that's $2,500 per month, for example, and then we have other debts of $500 a month, then that $3,000 versus $8,500 would put my debt to income ratio at 35.2%. Okay, so that's how the debt to income ratio calculation works. What we'll do during a home buyer consultation with you is we'll kind of walk you through what that debt to income ratio calculation looks like as we evaluate your overall finances. Now, the last stop in designing this home buying plan is around assets. Now, you heard me talk a little bit about what's needed for your home purchase around savings for down payment, as well as closing costs. These are some of the acceptable documents in kind of putting together the sources for assets. So checking and savings account, usually we want to see the last 2 months of those accounts. Cash deposits are not allowed. So if you have cash deposits going in, those do have to season at least 60 days for them to be eligible for the financing. Retirement accounts like 401ks, 403bs, IRAs, those can be potentially used. I would just encourage you to talk to your financial advisor, maybe your tax advisor, because we don't want to create a tax event by, getting access to those accounts. But with 401ks and 403bs, you're usually taking a loan out against those accounts. But again, I would just encourage you to talk to those different advisors. Gift funds can also be used in purchasing a home. That allows you to be able to have help from family to support you with those down payment and closing costs. There's no maximum on gift funds. We do need to get at least a gift letter, which we have the template for that as a lender. And then they will kind of show proof of the asset and then transfer that asset to you as the buyer. Okay, so that's pretty commonplace for first-time buyers to be able to have some help from family if necessary, because we do understand it's challenging to be able to have enough savings to be able to purchase your first home. And across the country, there's several different state agencies that help with first-time home buyer programs. Every state generally has an HFA, which is a housing finance agency. In Virginia, in DC, there's opportunities for first-time homebuyer programs. Since our class is obviously for a Maryland alum, and you may or may not be in the Maryland area, I wanted to kind of just share with you some of the first-time buyer programs available in the state of Maryland through the Department of Housing. There's the MMP First-Time Homebuyer Advantage program, allowing you to get up to $6,000 in a no-interest loan that can help with those down payment and closing costs. The minimum down payment is 3% on a conventional loan, or you could get help to satisfy that, as well as up to 5% for assistance on a conventional loan. So those are great opportunities. And I would encourage you to connect with us to talk a little bit more about those specifics. We'd love to be able to help kind of design some options around that. There's also the Flex Direct program for low interest rates on down payment assistance as well too. So I think a lot of these programs can help make a home ownership a lot more affordable for you when it comes to owning a home. Most of our first-time home buyers have limited savings. So when we can incorporate first-time home buyer programs, it really can make first-time home buyer programs that much more in reach. Okay, so I'm going to just answer a quick question on air just so we can get this out to the group. So the question is regarding debt to income ratio. How is credit card debt factored in? Is the monthly billing statement used? I.e., if you pay off your credit card off before the billing statement, will your credit card debt seem like zero? So great question. And we review this in our consultations with clients. So if you're in the habit of paying off your accounts after the billing cycle date, then that balance and minimum payment will show up on the credit bureaus. So we do count the minimum credit card debt. However, as we meet one-on-one and we'll review your debts, and maybe there's an Amex, a Visa, and a MasterCard, and you say, hey, Jason, I pay those off monthly, then we're going to zero out that monthly payment so that does not count against your debt to income ratio. But if you do run a balance pretty consistently, or if you have a large balance that just doesn't unfortunately get paid off every month, we can factor those into the debt to income ratio. Okay, great question. All right, I want to take you through now the 6 steps of home buying. So this is a visual aid to help you kind of understand, like, where do we go from here? So after attending tonight's class and you want to meet with us for a consultation to design a home buying plan for you, like, what does that look like in trying to get on that path towards home ownership? So step 1 is going to be actually the output of a consultation. That's called a pre-approval. And that's where we've designed financing options for you and really have your eligibility on a pre-approval certificate. That pre-approval is good for 60 days, but what's nice about that is we can always recertify that pre-approval at any time, because most of our first-time buyers especially are not going to find that dream home right away, right? I've had some clients that have been shopping for homes even the last 2 or 3 years, especially with what kind of occurred in the 22 market. So a lot of those first-time buyers are coming back to the market. So we would encourage you to, obviously get that recertified so you can continue that home search. But at the end of the day, that pre-approval certificate is going to be the output of a consultation and good for 60 days. So when you have a pre-approval, that's something that gets presented to the seller so that when you make an offer, they understand that your financing is all secured. Step 2 is going to be home buying, or the house hunting, I should say. What that's going to be is that's where I'm going to kind of start looking at different homes. I'm probably going to start my search online and then partner with a realtor. Maybe I start with a realtor to find maybe different neighborhoods, different property options are going to meet the criteria that I'm looking for in my next home. And as first-time buyers, it's probably not going to be the perfect house, right? But it is a stepping stone for us into the next home potentially. Most buyers, this isn't going to be their forever home, especially in a first-time buy. Most buyers are in their home for 5 to 7 years. But at step 2, you're going to start the house hunting. Working with a realtor, I think, is really important because they're probably going to be they should be the local expert. So they understand some of the kind of features and benefits that are existent in that particular community. Now, if you do decide to make an offer on a home, we can always update your pre-approval to match your offer price. So if you get pre-approved for $400,000, but you fall in love with the house for $350,000, we can amend that pre-approval to match your offer price. Step 3 is going to be basically the acceptance of the offer with the seller. We also call that entering escrow. And for different states that we lend in, it has different terminology, but we're going to say that that offer has been accepted and now we're entering escrow. So generally the escrow time period is 30 days. So from the time that a seller has said, yes, we'll accept your offer to the time you get your keys, it usually takes about 30 days. In some states, it can be a little bit shorter of a time period. But once that offer has been accepted, we're going to reach out to you, say congratulations, because that's a big step in the process. We're also going to set you up for a follow-up consultation and kind of talk to you a little bit about next steps in the process. That will also require you to more than likely make an earnest money deposit. And that deposit is usually 1 to 2% of your sales price. And that deposit will vary based upon what community you're going to buy in. So in some states, that deposit might be a little bit higher, but it will count towards your total out-of-pocket expense. So from there, we're going to go through a follow-up consultation with you, go over kind of the state of interest rates. We're going to advise on locking your interest rates and what that strategy looks like. We're going to take you through your closing cost, what your out-of-pocket expense looks like, and then we're going to deliver to you disclosures for your financing. We're also going to order your appraisal of your home. Your realtor is going to order your inspections of your house. And that really kind of just starts the process of the escrow time period. Now, I mentioned earlier, you have your earnest money deposit, usually 1 to 2%, kind of as a rule of thumb. That money will be protected by what we call the contingency within your contract. So for most contracts across the country, there's going to be a contingency period for buyers that allows you to do your homework on the property. That will include appraisal contingencies that allow you to make sure that home is worth what you're buying it for, inspection contingencies, which allows you to do home inspections, maybe pest inspections, make sure the house is in sound condition, and of course, get your loan approved with your lender. And of course, we would help you through that. That's really important because we want to make sure your deposit that you've elected to put down is protected while you're in that contingency period. Step 4 is going to be the processing and the underwriting of your loan. And so that is more of the administrative task of your loan. We're going to verify assets. We're going to verify employment. By that time, we also have your rate locked in for you. Okay, so we had a question that came in, which is, what are other ways to back out of the offer without financial penalty? So, as long as you have that contingency period, that's kind of your protection of the financial penalty, so to speak, of losing your deposit. So, getting your inspection done, if the house did not appraise for what you expected it to, that could be a potential out. Of course, if your loan didn't get approved, but your realtor will help kind of coach you through that. Of course, we want to make sure you're in the best possible financial position. So we don't want to get ourselves in a spot where we can't get out of. So step 4 is processing and underwriting. And then step 5 is going to be after the loan approval has occurred with underwriting. By that time, we've also had your appraisal back. Usually appraisals would take about a week to 10 days, especially in this market right now. And at step 5, once we have the loan approval, we're also going to deliver to you a final closing disclosure. Throughout this process, every disclosure you receive as a buyer is all e-signature disclosure. And the final closing disclosure shows your final funds to close, final closing costs, so you have a clear picture of what to expect. But it also creates a 3-day cooling off period, because we want to make sure that the financing that you're receiving matches up to what we've talked about throughout the process. And at step 5, there is no surprises. I mean, you'll see consistency of disclosure sent out from our team. Step 6 is going to be the closing of the loan. And that's where you sign final documents in person with the public notary. That process usually takes about an hour to an hour and a half, depending on, how extensive the financing is, whether you have assistance programs or not. At that time, you'll also wire in your final funds for the closing of the home loan. We'll also wire in the funds for the mortgage, and those monies get balanced and reconciled with the escrow company. And once all that occurs, then documents get recorded with the local county recorder's office, or the attorney records documents, depending on what type of state you're in. When those documents get recorded, usually it's a grant deed in some way, shape, or form that transfers ownership to you, as well as a deed of trust. And that's a security agreement for the loan. Once we get confirmation of those 2 recordings, then you become the official owner of the home. Then you get a chance to celebrate. Go ahead and tell all your friends and family about the big accomplishment, because it is a big deal. Again, that's going to be probably one of the biggest investments you make in your upcoming financial futures. So some questions came up while I was going through the 6 steps of home buying. One is, who pays for the appraisal? So the buyer pays for the appraisal. And in our process, that appraisal gets collected at the very end. It's part of those closing costs that we talked about earlier. And another question is, what happens if the bank appraised the house above or below the accepted purchase price? What happens? So there's actually a 2-part question. So in lending, we can only lend on the purchase price or appraised value, whichever is less. So I go out, I find a home I love, I make an offer for $400,000. However, the house only appraises for $380,000. So as a lender, I only can lend on that $380,000. So clearly there's a $20,000 gap. You have the option of a couple things. One is, of course, renegotiate with the seller to say, hey, gosh, the house is not worth $400,000. I'm willing to pay $380,000. If the seller's unwilling to accept those terms and you still really want the house, then you would have to make up the $20,000 difference. Okay. The second part to that question was, is furniture included into the price of the home? So generally not. Well, it's not going to be included. That won't be factored into the valuation. Now, your purchase contract may include maybe the refrigerator, the washer and dryer, if the seller's willing to part with that. It just depends on the situation. Question was, how much should we expect an appraisal to cost, and how much would an inspection cost? Are these included in closing costs? So the appraisal cost would be factored into closing costs, and usually appraisals will vary because it depends on the location of the property. I would estimate $500 to $700. It really depends on the location and what state you're purchasing in. And then the inspections will vary by where you're located, but what inspections you want, because it's not just a one size fits all with inspections. There's home inspections, foundation, pest inspections, sewer, pool inspections, roof inspections. Those all can kind of add up depending on what you want to do to kind of do your homework on the property. I would say, as a rule of thumb, they're probably about $500 to $600 for home inspections. And those won't be factored into the closing cost calculation we provide, because we just don't really have a good gauge on which inspections you're going to, really want to take advantage of. I would encourage you to work with your realtor on what inspections are right for that particular property. Now, as we move forward as a class, you may be kind of considering homeownership, and we love to be able to help you on that journey towards homeownership. We do consultations with clients throughout the day. That's a one-on-one session with me and just kind of building a home buying plan for you. That's about 30 to 45 minutes over video. The first steps in that process include submitting an online application. We only do a soft credit check, so you don't have to worry about the impact of your credit score. You upload some documents, and then we meet with you over video to design a home buying plan for you. And I think that's a really important step in the process because, many of our buyers are at different stages in that process, whether it's just kind of discovery, like, I don't know what to do next. I just want to figure out what it could look like in the future. Some of our buyers are ready to go right now, and we just want to make sure we help you on that path whenever that time frame is there for you. Now, if you have some questions after today's class and maybe they didn't get answered on our Q&A, we really encourage you to connect with us for an intro call. We can talk about the next steps in the process, or maybe some questions around credit, whatever you prefer to do. But that's about a 10 to 15 minute call that we set up with our clients. Here's what the framework of that consultation looks like. So we'll go over, your budget. We'll talk a little bit about location and sales price and closing costs and obviously monthly payments, and just design a kind of a comprehensive plan for you. You heard me talk a little bit about the mobile app earlier today. So here's the link to the mobile app available for Android and Apple. Really great tool that you can kind of follow the progress of your application. You can apply right online with your application. A lot of our clients will use that for their calculators too. So as they're looking at homes on a weekend, they just pull up their mobile and kind of run some calculations to see what that monthly budget might look like for them. We're super proud of our partnership, of course, with Maryland. This, again, is our first workshop that we're teaching for our alumni community here, and I couldn't be more excited to be able to bring this content to you. We're also excited about what we can do within the partnership, not just helping educate you in homeownership, but the discounts provided in our partnership, which is a $750 discount in closing costs. Now, we also have other partnerships across the country. We do similar things with educational classes like this. So, you do have friends or family, maybe some coworkers across the country that want to tune into one of these classes. We'd encourage them to check out these workshops. They can be found all at mortgageeducate.com as a list of all of our classes for this year. And we'll be kind of updating those throughout the year. All right, so with that said, we're going to kind of come to the end of tonight's class, but I do have questions that are coming in, so I do want to answer all those questions on air before we wrap up tonight. And before I go into the questions, I really would encourage you to follow on some of our social channels, especially on Instagram. We're trying to give you good content that helps you in this home buying process. So we're updating that every week. A lot of great information that we share from our home offices here. And we have some wonderful stories and testimonials from past clients, many of which have attended our classes over the last 6 or 7 years. So we'd encourage you to kind of check those out. All right, so one of our questions that came in, which is, do some states offer lower interest rates for first-time home buyers that you partner with in other states? So there can be some geographic changes in interest rate offerings. There is, for all across the country, there is lower rate offerings for what we call low-income housing buyers. So if you're a homeowner or a future homeowner that makes less than 80% of the median income, usually those interest rates can be slightly lower. Okay. A really important question that came in is, how is our data protected when submitting W-2s, pay stubs, et cetera, to your team for consultation? So everything is all under secure. We have 2 different options. You can upload information right through your application securely, or we have a separate secure link if you want to send that to, we can send that to you as well. So once your application is submitted, we can send you that separate link if you want to. Privacy of our customers and security is super important, especially as a financial institution. We take that security super serious. So yeah, so we definitely want to make sure that's taken care of. Are most of your clients based in Maryland and California? So most of our clients are all across the country. So Maryland is a new opportunity for us with our partnership with Maryland for our specific team. American Pacific Mortgage is a nationwide organization. And, what's really cool about technology, and we learned this obviously through the pandemic, we work with clients now over video. So whereas we were mostly brick and mortar prior to 2021, a lot of our work we do with clients is now over video. So whether we work with a client in LA, or we work with a client in Maryland, or a client in Sacramento, we can still provide the same great service and experience for our clients, which is really cool. So geographical differences, where's your strongest expertise? I think for me, I think it's not necessarily geographical experience. I think it's more our expertise. It's really just kind of first-time buyer experience and expertise, because I understand kind of what first-time buyers go through in working with several hundred clients that are all primarily first-time buyers, probably 99% of those buyers. And so I think first-time buyers face similar challenges, understanding what the process looks like, having options, understanding that their budget's not going to be the highest and they're just getting started in their financial footing. And so I think taking the time and patience to help educate clients on what that can look like for them and helping them achieve their goals and objectives, I think really is where my expertise is in. So I don't think it's necessarily like a geographical kind of a boundary type thing. All right, those are great questions. You guys saved them up for the end. Okay, and then how many years should we own a home before selling? That's a great question. That depends. Everybody's financial situation is a little bit different. You may get relocated for a job that could help you or make you sell a home a little quicker. You may decide to upgrade your home and rent out your house. That may change. I think really selling a house is really it's going to vary by every situation. Sometimes with financing, we take a look at how much cost someone's putting into their home purchase, and we want to make sure they're going to get a good return on investment. But I think everybody's situation is a little bit different. I'd encourage you for that question, is something where when we design your home buying plan, let's talk about how long you think you're going to be in the home, and how much is financing going to cost you, and does it make sense? So I guess the second part of the question is they're saying, well, how many years before recouping closing costs? I think the recoup on closing costs is really hard to estimate, because you're going to have some hard costs that you can't really estimate or recoup. I think it's really going to come down to where you're at from a rent perspective. What does it look like for home ownership? Where we get into a recoup analysis is when it comes to discount points, because you're going to have a certain non-discount point rate. Let's say that's 6.75, but if you really want to achieve a rate of 6.25, it's going to cost you money, obviously, right? In closing costs. So that's where I think we get into more of a recoup situation. Usually buy down of rates are going to take 4 or 5 years to recoup as a real rule of thumb. And this question comes up, believe it or not, is it better, often in my conversations, is it better be married before buying a house with your partner? So it absolutely does not make a difference. So whether you're married, domestic partners, in a partnership, it does not change your qualifying for the mortgage. Now, for a VA loan, if you're eligible for that, that would change VA eligibility. But for clients that are in a partnership, does not make a difference. So you'll be a borrower and a co-borrower. Okay. Great questions. All right. Well, I got a question for everyone. Does anybody know the next game for Maryland? And is it 2 days from now? Nobody knows? I guess I probably should look it up. Obviously, big win today, and into the round of 32. So, I thought that would be kind of cool to kick off tonight's first class here with you guys with that big win. It's an absolute pleasure to bring this workshop to you tonight. Hopefully this information was helpful for you. I really look forward to connecting with you and hopefully helping you design your own home buying plan for your upcoming home purchase. And of course, if you have any questions, any follow-ups to tonight's session, love to be able to have you just reach out to me. All my contact information is here. Have a wonderful evening. We'll talk to you soon.